Good day, everyone. For today's lesson, we will discuss derivatives and risk management. We will define derivative securities, the reasons to manage risks, the fundamentals of risk management, and using derivatives. But first, let us try to identify the definition of a derivative. A derivative is any security whose value is derived from the price of some other underlying asset. In short, its value is based on something else. The asset where the derivatives gets its value is known as the underlying asset. It can take many forms such as stocks, bonds, commodities, currencies, interest rates, and market indices. Always keep in mind that the derivatives or the value of the derivative is the value of something else. Why might stockholders be indifferent to whether a firm reduces the volatility of its cash flows? Indifferent here means that regardless of the alternative, the result or the cost and benefit will always be the same. Number one here is diversified shareholders may already be hedged against various types of risk. In stock investing or when you invest in a stock, it is important to diversify. There's a famous saying that you do not put all your eggs in one basket. This means that by diversifying your options, you are reducing the risk. You allocate your investments across various or different financial instruments and industries. An example of this is what we are currently experiencing. This pandemic has hit global trade and supply chains. So if you only invested in these sectors, it might be difficult to offset your gains. We have securities that remains profitable regardless of economic trends because they are basic needs of human. One example is a utility company. People need power and heat for themselves and their families. So this utility company is very important because regardless whether there's economic trend or not, or whether there is volatility in the market or not, this type of stock is important. It's a basic need of human. Number two, reducing volatility increases firm value only if it leads to higher expected cash flows and or reduced WACC or the weighted average cost of capital. So some investors are risk averse. They have low appetite in terms of risk. So when there's volatility, there's uncertainty. Okay, you reduce the volatility when there is certainty on expected cash flows or the cost of capital. Reasons why corporations engage in risk management. Number one, reduces the volatility of cash flows and this decreases the probability of bankruptcy. Again, the higher volatility corresponds to a higher probability of a declining market, while lower volatility or the less frequent fluctuation in the market corresponds to a higher probability of a rising market. Mas gumaganda yung ekonomiya if that's the case. Number two, maintain their optimal capital budget. When you talk about optimal or optimum, that is the maximum. So it means that by reducing the need for external equity, firms can maintain the optimal or the maximum capital budget. Okay? So, number three, risk management avoids financial distress costs. Yes, because risk management is important to avoid such financial distress. This usually arise from poor budgeting, kapag may overspending, or when there's too high of a load of a debt or utang. Okay, then it becomes financial distress in the longer period. Number 4, utilize the comparative advantages of managers in hedging certain types of risks. As you know, managers can be utilized so that they can employ a strategy to offset losses in investments. The managers who are proactive are highly to reduce risk rather than the managers who are reactive. So, these types of managers know how to forecast and speculate. They're good in planning. So, they are an asset in terms of risk management of an organization. Okay, so you have to maximize or utilize them to achieve a certain goal, which is to hedge the certain types of risks. Number 5, reduce the risks and costs of borrowing. Certainty in terms of cash flows reduces the risks and borrowing. Okay. Number 6, reduce the higher taxes that result from fluctuating earnings. Again, when you have stable returns, it will have stable taxes. So, ang kalaban ni risk management is the volatility or the fluctuation in price of the market. And number 7, initiate compensation programs to reward managers for achieving stable earnings. As you know, managers have become a comparative advantage. It's an advantage in terms of hedging risks, okay, managing risks, being proactive. Therefore, there are different performance measurement tools wherein you can reward the managers for accomplishing or achieving the target of the organization, specifically in terms of their stable earning. Okay? There are different types of derivative. We have the forwards, futures, swaps, and options. So we'll go through them one by one. The first one is forwards. It is a customized contract between two parties to buy or sell an asset at a specified time at a specific future date. So remember the words. It is a contract to buy or to sell an asset. There is a specific price at a specific date, future date. Futures, on the other hand, is similar to forwards, but they are standardized and regulated. We also have swaps. As the name imply, it is an exchange of one security for another security. We also have what we call options. Options is a contract that gives the right. Again, it is a right but not the obligation to buy or sell a security or other financial asset. What is an option? It is a contract that gives its holder the right to buy or sell an asset, but it is not the obligation. Okay? And it gives the holder the right to buy or sell an asset at some predetermined price within a specific period of time. There are important characteristics of an option that you have to remember. The first one is that it does not obligate its owner to take action. So, after a specific period of time, you don't have any obligation for this option. Second, it merely gives the owner the right to buy or sell an asset. It's only a right, okay? Not an obligation. So there are two different things. There are different concepts on options. The first one is a call option. So remember, pag sinabing call, it pertains to buy. Bumibili ka ng stock. Okay, specific number of shares of a security within future period time. When you say put option, it's an option to sell or this time nagbebenta ka ng number of shares. Nagbebenta ka ng security within some future period. Let me just later we'll give you examples of this. Exercise or strike price. It's another concept of option that means the price stated in the option contract at which the security can be bought or sold. Another concept is the option price, which is the market price of the option contract. Now let us familiarize ourselves with the following terminologies. Again, remember that call pertains to buy, put pertains to sell. Another concept for options is the expiration date. Again, expiration date is the date the option matures or the maturity date of the option. Another concept is exercise value. This is the value of an option if it were exercised today. So the formula in getting exercise value is current stock price minus the strike price. Another concept is covered option. When an option written against stock held in an investor's portfolio, it's what we call covered option because nakatago siya. Another is naked or uncovered option. When the option sold without the stock to back it up is another option. When the exercise price is below the current price of the stock, the call option is in the money. Again, it's an option whose exercise price is below the current stock price. Whereas out of the money call is a call option whose exercise price exceeds, sobra daw yung exercise price sa current stock price. Okay, that's why it was called out of the money because sobra siya. Another term is long-term equity anticipation securities or LEAPs. These are similar to conventional options, which is normally 3 months, whereas this LEAPs has a longer term options having maturities of up to 3 years. Okay. LEAPs provides buyers with more potential gains and it offers better long-term protection for a portfolio. This is an example of an option. As you can see, a call option has an exercise price of $25 and has the following values or the call option price. As the stock price increases, same goes with the call option price. If it keeps increasing, we will highly likely exercise our right to buy. How to determine the option exercise value and the option premium. So on the left part, we have the stock price amounting to $25. Next is the strike price with the same amount. The exercise value, how is it computed? For you to get exercise value, you deduct current stock price. The current stock price is $25 minus strike price. So 25 minus 25 equals 0. Our given strike price is constant for $25. Now, the higher the stock price, the higher the exercise value. If you can see, $25, there's 0 exercise value. With the given examples, we have a stock price of from 25, 30, 35, 40, 45, and 50. If you'll notice, the exercise value keeps on increasing. And on the last line, for $50 stock price, we have an exercise value of $25. So how about the option price? The option price is the market price of the option contract. Okay, so how do you get the option price? That is already the market price of the option contract. The option premium, on the other hand, if you'll notice, option premium decreases as the stock price increases. So, habang tumataas ang stock price, the option premium keeps on decreasing. Bumababa yung value. Okay, so option premium is option price minus the exercise value. Next, how does the option premium change as the stock price increases? Number one is the premium of the option price over the exercise value declines as the stock price increases. This is due to the declining degree of leverage provided by options as the underlying stock price increases habang tumataas and the greater loss potential of options at higher option prices. These two factors, they actually help explain why the premium diminishes or decreases. Bakit bumababa as the common stock price rises. Okay? There is an indirect relationship between the two. In this diagram, you will see option value and the stock price. Market price is the blue line, while the purple line is the exercise value. What are the assumptions of the Black-Scholes option pricing model? We have the first, which is the stock underlying the call option provides no dividends during the call option's life. Second is that there are no transaction costs for the sale or purchase of either the stock or the option. So we are trying to check the assumptions, what is being assumed in terms of the Black-Scholes option pricing model. Are you going to buy or are you going to sell the options? Okay. And then we also have the third, which is a risk-free rate is known and constant during the options life. The fourth one, security buyers may borrow any fraction of the purchased price at the short-term risk-free rate. No penalty for short selling, and sellers receive immediately full cash proceeds at today's price. Call option can be exercised only on its expiration date. Security trading takes place in continuous time and stock prices move randomly in continuous time. Okay, so again, these are the assumptions of the Black-Scholes option pricing model. Okay, now let us move to the equation that must be solved to find the Black-Scholes option price. So we have the following formula. So how do the factors of the Black-Scholes affect a call option's value? As you see in this slide, as the factor increases the option value, so you may choose from the following analogy. Okay. What is the corporate risk management and why is it important to all firms? So here we have identified that the corporate risk management relates to the management of unpredictable events that would have adverse or serious consequences for the firm. Another one is that all firms face risks. Napakadaming risk. And we have to identify. Okay, but the lower those risks can be made, the more valuable of the firm. Other things held constant. Of course, risks that are associated with loss of a firm's productive asset. This is what you call property risk. How about result from human actions? That's the personal risk, yung mga frontliner. Another is the environmental risk. It is associated with polluting the environment, so making it clean and green. Liability risk connected with the product, service, or employee liability. We also have insurable risk, and this is a risk that's typically covered by insurance. Another type of risk would be speculative. It offers the chance of a gain as well as a loss. Another is pure risk that offer only the prospect of a loss. Demand risk associated with the demand of a firm's products or services, while the input risk is associated with the firm's input cost. Financial risk is a result from the financial transaction. So these are the different types of risks. What are the three steps of corporate risk management? First is it identify the risks faced by the firm. It measures the potential impact of the identified risks, and it decides how each relevant risk should be handled. So these are the three steps to corporate risk management. Another question posed here is that what can companies do to minimize or reduce risk exposure? Okay. First, transfer risk to an insurance company by paying periodic premiums. Transfer functions that produce risk to third parties. Purchase derivative contracts to reduce input and financial risks. Okay, you should also take additional actions to reduce the probability of occurrence of adverse events and the magnitude which is associated with such adverse events. And it avoids the activities that give rise to risk. Okay? A financial risk exposure refers to the risk inherent in the financial markets due to a price fluctuation. So there's actually no clear guideline for this. An example is that a firm holds a portfolio of bonds, interest rates rise, and the value of the bond portfolio falls. How about derivative? Again, derivative is a security whose value is derived from the values of other assets. So let me do a quick recap of what we have discussed. Futures are contracts that call for the purchase or the sale of the financial asset at home with the future date at the price determined today. So this can be used either as highly encouraged speculations or to hedge to reduce risk. Okay, so we have been saying the word hedge since we've started. Now, hedging means usually used when the price of exchange could negatively impact or affect the firm's profits. So usually you are the catalyst. Okay, the long hedge involves the purchase of a future contract to guard against the price increase, while a short hedge involves the sale of a futures contract to protect against a price decline. And of course, swaps. Okay, again, from the word swaps, it is the exchange of cash payment obligations between two parties, usually because each party prefers the terms of the other's debt contract. So swaps can reduce each party's financial risk. How can commodity futures markets be used to reduce input price risk? So as you know, the purchase of a commodity futures contract will allow a firm to make a future purchase of the input at today's price. So even if the market price on the item has risen substantially in the interim. So with this, thank you so much for listening and keep safe everyone.